Our guest tonight is William Borton from W.R. Borton and Associates. Good evening, Bill.
Good evening, Paul.
How are you tonight?
Hi, Brian. I'm fine. Thanks for asking, Paul.
So you've been in the insurance business for 30 years or so, and I know you spent a lot of that time doing employee benefits. So why don't you talk about what motivated you to launch your own firm and focus on long-term care?
Thanks for asking, Paul. I witnessed both my parents go through the long slide brought on by dementia, and both of them ended their lives in nursing homes. And my siblings and I had to mourn their loss basically while they were still alive. We went through the financial, emotional, psychological, and logistical issues and challenges that go along with all that. And so I have a lot of sensitivity to the subject of end-of-life care or long-term care around that issue. Then when a close friend of mine, who's a little bit older than I am, contacted me from Tucson, where he retired, and asked me to help him find a suitable long-term care solution, I ended up doing a lot of research. And what I discovered was rather shocking.
Well, what do you mean by that?
Well, what I discovered is that nearly every American has a huge hole in their health insurance plan. What I mean by that is that commercial health plans, both individual and group, and even Medicare, don't cover long-term care costs. One exception, of course, is Medicare, under certain circumstances, can cover it for a short period of time. But for the other, for the costs that are involved for long-term care, basically people are on their own.
And we talked about inflation, earlier on. One area you're seeing a ton of inflation is in the cost of long-term care. You can see that trend continuing?
Well, healthcare costs in general have been increasing for years at a higher rate of inflation than the general economy. So one of the other things I discovered is that for Americans over the age of 65, 7 out of 10 will experience a long-term care event during the remaining years of their life. But another surprising fact that I learned is that 40% of all extended or long-term care events, as I call them, occur with people between the ages of 18 and 64, which really surprised me.
Yeah, that is surprising. So,
and why is that, Bill?
Well, people between the ages of 18 and 64 have accidents, sudden illnesses that aren't age-related, things along those lines. And of course, we all know that when the insurance company stops paying, the hospital discharges, whether you're ready to be independent again or not. So many people find themselves for extended periods of time, and in some cases, a long period of time or the rest of their lives, where they require health care that's not covered by the insurance, their health insurance.
Right. I guess for the younger segment, that'd be more disability insurance that would kind of cover that, or you're saying they might have a need for long-term care?
Well, disability income insurance would cover a portion of their lost earnings if they had disability insurance. Many people don't.
Right, true.
Okay.
It's true.
But the extended health care costs are home health care, assisted living, facility-related costs that would not really be adequately covered by 60% of your pre-disability earnings.
Right. So I know you mentioned a lot of the stuff you're talking about is risk management, and you're a risk manager. Explain that. What do you mean when you use that term, risk manager?
Well, when I refer to myself as a risk manager, I'm dealing with emotional risks and financial risks. Now, when a family member has to deal with an aging parent, perhaps, that has a dementia-related cognitive impairment, as it's called in the business, related disability, or they're no longer able to care for themselves for physical reasons, this can add a lot of stress to the spouse or the children from a caregiving standpoint. So there's a lot of emotional issues, and plus for the person who's no longer able to care for themselves, they're having to deal with a lot of issues around their own mortality. Beyond that, you have the financial risk that if you have not adequately planned for this eventuality, it ends up costing thousands of dollars a month in many cases, and most people aren't prepared to be able to deal with that.
Right. So, people hear insurance, they kind of turn off, get a little turned off, like, oh, I have to buy more insurance. And I guess I've seen this in my client base. I agree with you. Your statistics is like most clients don't have long-term care insurance. They, they haven't thought about it, or if they did, they discounted it as too expensive. Where do you see this going? Because I think, as the Americans are aging, it's going to be a bigger problem. I mean, healthcare costs are astronomical. Long-term care costs are too, and people are woefully underinsured for it. So.
Absolutely. Well, when you think about managing risk and you think about long-term or extended healthcare costs, you are either dealing with risk retention or risk transfer. And risk retention, by default, is what most Americans have selected because, as you point out, they haven't planned.
Right.
And so when you look at risk retention, there's really only two segments of the population that aren't going to have a problem with that. One is the very rich, who can easily afford to pay the thousands of dollars of healthcare expenses out of pocket. And the other is the poor, who are either already at or close to the point in time when they'll be able to qualify for Medicaid and essentially get welfare from the government.
Right, which leaves a lot of people in the middle.
Yes.
So.
Yes. And the people in the middle, who probably include us, are the people for whom long-term care insurance is at least a consideration. It warrants investigation and education, and then hopefully making a rational decision.
So if you were to look at long-term care insurance, I mean, there's really no free lunch, okay? So you pay the premium, and you know that part of the premium goes to the insurance company, and then a part of it's going to get invested. How does it work so that this becomes a real benefit ultimately to the payee, that you're going to end up getting more benefits down the line than you're going to pay in?
That's a good question, Paul. Insurance companies are not in the business to lose money.
Correct. That's why I asked.
Yeah. Well, I had a feeling that was why. And as we all know, with this zero interest rate environment that we've been dealing with, insurance companies have been really challenged by that for several years now. They invest primarily in bonds. And as you were saying before, bond yields have been very low unless you incur a lot of risk. And insurance companies are not about incurring a lot of risk. And so they're trying to meet their obligations based on the spread between what they're earning and what they have to pay, and of course their reserves, which they're required by the government to maintain. But it's challenged a lot of insurance companies to the degree where several of the major players have gotten out of the long-term care business, have stopped writing new policies over the last couple of years, and others that remained in the game have had significant rate increases for their in-force blocks of business.
Yeah, I mean, I've seen that, at least in a handful of clients that have to long-term care, that the premiums have gone up every year and probably have doubled in the last 7 maybe.
Well, it depends on the insurance carrier. The stock companies that are in business for the stockholders have been more volatile. The mutual companies tend to be better reserved and have had less volatility. In fact, some of them have not raised rates for existing blocks of business thus far, although they certainly have increased rates for new applicants. So, but back to your question, Paul, the value that you receive from long-term care insurance is going to be a greater value than self-funding, because there is some leverage even with the current low interest rate environment. It's going to depend on how old you are when you purchase the coverage, what kind of health you're in, what gender you are, and that's another issue because the insurance carriers are starting to file for gender-specific rates because women require a lot more long-term care statistically than men. So women in the next quarter or so are going to be paying a lot more for long-term care insurance than men.
That's because men have a tendency to die as opposed to linger.
More or less, yeah. Women tend to be on long-term care claim about 2.5 times longer than men. And for instance, when I used to go to the nursing home to visit my dad, there were very few men's names on any of the rooms down the hallway. They're mostly women.
Yeah, it's like a 8-to-1 ratio, I think, something like that.
So depending on your age and your gender and your health, because you do have to qualify for insurance, they don't just give it away, unless of course it's health insurance under healthcare reform. The issue then is how much leverage can I get? And of course the younger you are, the more leverage you're able to buy.
How do you obviously long-term care traditionally is for retirees. How do you convince them that they're trying to maximize their retirement income. Now they have to take a sliver of that and now buy insurance, right? That seems to be the biggest obstacle, at least from what I hear from my clients, is like, I need my income to live. To take money to buy insurance that I hope I never use is just another expense that I wasn't planning on.
Well, in order for long-term care insurance to work, it has to be affordable. There has to be a way of enabling you to obtain some amount of coverage that's going to provide meaningful benefits without it altering your lifestyle to any great degree. Otherwise, it's just not going to make sense. So there's a number of ways that people address the issue. People are buying less inflation protection now. The insurance companies are no longer offering lifetime benefits, so coverage is being scaled back. Another issue that I find is that people who have significant assets are looking at some of the newer generation hybrid policies, which are basically a combination of long-term care and life insurance that can be had for either one large single premium or lump sum, or with a relatively short number of years that you would pay. And so people are taking assets that may not be needed for savings or investments and shifting them over to an insurance company, and in some cases creating a multiple of 4 to 5 times their initial investment. Also, long-term care benefits are paid income tax-free.
So I guess the thing is, so with these hybrid policies, there are also life insurance policies. So is the thought that if you don't use the benefit for long-term care, you then will get a death benefit?
Well, you don't, Paul,
but my heirs hopefully
your
would.
beneficiaries do, yes. The traditional long-term care product, which has been around for about 35 years, has had a number of objections that have caused people to resist buying it, which is one reason why so many of your clients haven't done so. And that is the cost can go up, not on the individual, but on the class of people who have the policy, and they have gone up. The other is what you're referring to, Paul, is what they call use it or lose it. And even though with car and home insurance you pay and hope you never have a claim, for some reason with long-term care insurance it's different. People don't want to pay, $50, $100, $150,000 in premiums over their life and end up never needing the coverage and having the insurance company keep their money. So the hybrid plans that have a life insurance component to them overcome that objection by paying a reasonable return on the initial investment in tax-free death benefit to your heirs. So you get guaranteed cost, you get a nice step up on your investment should you die conveniently, as I put it, and if you go inconveniently and need long-term care, then again you can end up with as much as a 4 or 5 times multiple.
Where do you see the industry heading? Do you think they'll continue to get creative on the products, or is the hybrid kind of the solution you see?
Absolutely. It's a good question, Brian. It seems like things are changing almost weekly at this point. I continually find announcements about carriers that have gotten out getting back in, or those that are in raising rates, going to gender-specific rates, charging women more. There's a whole lot of change. It's a very volatile time. And there's a number of factors that relate to this. The continued low interest rates is probably one of the largest, but also people are holding on to their policies. When insurance companies price life insurance, they assume about 20% of the people that buy it are going to drop their policies before they die. But the industry average on people that drop their long-term care policies is an amazing only 1%.
Okay, so they're not benefiting from the free ride. So we have time for one short question because we're almost out of time. If you were to give advice for people as to how they should think about long-term care, when should they start getting it, if they should start getting it, and who should they really have a conversation with about the appropriateness and how to maybe structure it, what advice would you give them?
Well, generally speaking, when you're looking at the continuum of risk management across your life, long-term care planning, most people think age 50 to 60 in that range, but I find really the time is most dependent upon when people are no longer focusing their spending and their attention on their children. When education, weddings, things along those lines are out of the way, then couples tend to look at each other and say, okay, now it's time for us. And so this is about the time when people start wanting to talk. Now, people should be looking at dealing with a competent insurance advisor that represents a number of different insurance carriers, and they should also be consulting their financial advisors, their wealth manager, their accountant as well. Now, I prefer to collaborate with people's advisors because in order to do a proper job, it's a team approach to best accomplish those goals.
All right. Well, we are out of time for tonight, and I think we had a really interesting discussion tonight on long-term care insurance. And next week, our guest is Thomas McClellan. He's CEO of Treatment Research Institute. They are doing research in alcohol and substance abuse and how that is changing under the new health care law. And from all of us here, your money matters.